Ever feel like you're just drowning in financial news?
Hmm.
Trying to pick out the few drops that actually matter for your investments.
Oh, definitely. It's a real challenge knowing what's truly going to move the needle on returns.
But what if we could sort of zero in on the core principles? The things research shows actually predict how stocks will perform.
That's exactly the deep dive we're taking today. We're trying to forget the noise and, the hype.
Right.
We're unpacking solid academic research to understand the fundamental engines driving stock market returns.
Welcome to the deep dive. Our goal is pretty simple. Take complex stuff,
Yeah.
detailed research, maybe some brainy articles, the kind of things that can make your eyes glaze over,
Mm-hmm.
and pull out the key insights that you can actually use. We're trying to be your shortcut to understanding what matters and hopefully keep it interesting along the way.
And today we're focusing on this really fascinating study called Digesting Anomalies, an Investment Approach. It basically looks at how a company's decisions, specifically about investing and how profitable it is, are deeply connected to the returns you might see as an investor.
So think of this as getting the cheat sheet, maybe,
Mm-hmm.
to understanding why some stocks perform the way they do.
Exactly.
We want to give you a clear way to look at the market, maybe spark some aha moments without getting totally lost in complicated jargon.
Yeah, avoid the jargon.
Okay, so let's get into this. What's the really fundamental idea here? The main thing we should keep in mind.
Well, the core intuition, and it might seem a bit surprising at first,
Okay.
is that when a company is pouring a lot of money into new investments, it can actually signal lower expected returns for investors down the road.
Uh-huh.
And on the flip side, companies that are highly profitable tend to offer the potential for higher future returns.
That does feel a bit backwards, doesn't it? You'd think, well, more investment must mean better growth, better returns, right?
I think that.
So why might high investments suggest lower returns?
Well, try thinking about it from the company's point of view. Investment often ramps up when the cost of capital, how expensive it is for them to raise funds, is low.
Okay.
So when money is cheap, they might chase a wider range of projects, maybe even some that aren't necessarily blockbuster opportunities.
Right.
So high investment can sometimes be a sign that, the bar for what gets funded isn't actually that high.
I see. So if it's easy and cheap to invest, companies might just invest in more marginal projects that don't generate huge returns.
Precisely. Now let's bring profitability into the picture. Specifically, let's talk return on equity, or ROE.
Okay, ROE.
If a company is generating really high profits relative to its equity, but it isn't investing much of that back into the business,
Uh-huh.
it suggests that investors are, well, maybe already expecting a lot from it. The discount rate is high. To balance things out, the future expected returns might actually be lower.
So high profits but low reinvestment could mean the good news is already baked into the price, and maybe future gains might be limited. What about the opposite scenario?
Well, low ROE but high investment might indicate the company isn't generating great returns on its existing stuff, but it's still investing heavily, maybe hoping for a turnaround.
Right.
In that case, investors might not be demanding huge future returns because, well, the current performance isn't exactly stellar. The discount rate might be lower.
Okay, this is starting to click now.
Hmm.
So high investment can sometimes be a red flag, suggests lower quality projects maybe, or just a low cost of capital environment.
Yeah.
While high profitability can signal strong performance that might already be reflected in the stock price.
Mm-hmm. Now, the research you mentioned, it has a specific equation, right? What's the key insight there without getting too bogged down in the math?
Right, the math isn't the main point for us here.
Right.
The equation essentially formalizes this balance we're talking about,
Hmm.
the cost of investing versus the expected future benefits.
Yeah. Think of it like this. A company will keep investing as long as what it costs them to make that investment today is less than or equal to what they expect to gain from it in the future, factoring in risk and the time value of money.
So it's basically a cost-benefit analysis for investment, but at the company level.
Exactly. And this is what leads us to how stock returns are determined. The research shows that a company's stock return is linked to its future profitability relative to its current level of investment. Companies that are highly profitable relative to their investment, they tend to have higher returns.
That makes sense. I mean, if a company is generating a lot of profit without having to invest too much to get it, investors are likely going to see a better return.
And this idea, it actually underpins a concept you've probably heard of: the weighted average cost of capital, or WACC.
Oh, right, WACC.
Yeah. When companies decide whether to take on a new project, they often compare the project's expected return to their WACC. Our discussion here gives a fundamental economic reason why that WACC matters. It reflects that balance between investment and expected profitability right at the margin.
So these firm-level investment choices have direct implications for the returns we see in the stock market. Okay, so what does this mean for us then when we're trying to figure out what kinds of stocks might have higher or lower expected returns?
Well, the key takeaway really is stocks of companies investing heavily today tend to have lower expected returns in the future.
Okay,
Conversely, stocks of companies with high expected profitability tend to have higher expected returns. Remember that equation we touched on?
vaguely.
It basically tells us that the expected return is, roughly, expected profitability divided by a factor that includes the level of investment.
So if we see a company that's on a massive investment spree, like building new factories everywhere, that might be a signal to maybe temper our expectations for future returns from that stock.
That's the general idea, yeah. And this also suggests the market isn't just a random walk, you know?
Well,
Stock prices actually adjust to reflect these expected differences in returns based on investment and profitability. Discount rates aren't the same for all companies. They vary depending on these fundamental factors.
okay, so how does this investment channel, this idea that high investment leads to lower returns, how does that play out in the real world? Are there specific types of stocks or situations where we really see this clearly?
Yeah, the research points out that many common ways investors categorize stocks actually end up sorting them by their investment levels, even if unintentionally.
Oh, interesting. Like what?
Well, for example, look at companies issuing a lot of new stock.
Okay.
They're often doing that to fund new investments, right?
Yeah.
And the data shows a pretty clear negative relationship between issuing new stock and future average returns. Companies that issue more tend to have lower subsequent returns.
That fits the pattern perfectly. Issuing stock is a form of investment, and higher investment links to lower expected returns. What about just a company's overall growth? Is that related?
Absolutely. A company's asset growth, how much its total assets are increasing, is a really good comprehensive way to measure its investment activity.
Right.
And the evidence here is quite strong. Companies with high asset growth tend to have significantly lower future stock returns.
Wow.
The researchers even call asset growth one of the premier manifestations of this investment channel at work.
So maybe be a bit wary of companies that are just rapidly expanding their asset base.
Yeah.
Okay, now what about the classic value premium? You know, the tendency for value stocks, high book-to-market ratios to outperform growth stocks. How does investment fit into that story?
The investment principle offers a really interesting angle on the value premium. Think back to that cost-benefit idea of investment.
Okay.
Value firms, with their high book value relative to their market price, well, they often have fewer slam-dunk opportunities for profitable investment compared to, say, growth firms. They tend to be more mature businesses. And because they're not investing as aggressively, their expected returns are higher. That could be a big part of the value premium.
So value stocks might outperform not just because they're cheap, quotation marks, but because they're not plowing tons of money into new, maybe less profitable ventures.
That's the idea. And this also helps explain another pattern. Why stocks that have done really well in the past, high prior returns, sometimes underperform in the long run.
Ah, the reversal effect.
Exactly. That past success might have led those companies to ramp up investment, which then acts as a drag on future returns.
Okay, that gives us a solid handle on the investment side. Now, let's switch gears to the profitability channel. How does a company's profitability influence its expected stock returns?
Right, so our expected return idea also tells us that higher expected profitability tends to lead to higher expected returns.
Okay.
If a company is consistently generating strong profits, investors will often demand a higher return, maybe to compensate for lower perceived risk or just to reflect the potential for future growth driven by that profitability. You can even see a connection here to the well-known Gordon growth model, where a stock's value is tied to its future earnings potential and the discount rate.
Right, the dividend discount model.
Yeah, essentially. High expected cash flows profitability relative to the market equity implies higher discount rates, higher expected returns.
So highly profitable companies, relative to their stock price anyway, should generally offer better potential returns.
That's the expectation, yes. And this helps explain why certain strategies that focus on profitability tend to do well. Think about momentum investing.
Buying winners.
Buying winners, exactly. Buying stocks that have been performing well recently. Often, that recent strong performance is just a sign of high current profitability.
Ah.
And investors expect that to continue, at least for a while, which leads to higher expected returns.
So riding the momentum wave might actually work because you're implicitly betting on continued high profitability.
Interesting. What about companies in financial distress? How does profitability play a role there? Well, less financially distressed firms are generally more profitable, right?
Usually, yeah.
So, because they're on more stable footing and generating better earnings, they tend to offer higher expected returns compared to companies facing, significant financial challenges.
And earning surprises.
Yeah.
When a company reports profits, much better or worse than expected.
Positive earnings surprises can signal that a company's profitability is actually higher than people thought.
Right.
This new information can lead investors to revise their expectations upwards, resulting in higher expected future returns.
This all makes a lot of intuitive sense, really. Companies that are good at making money tend to offer better returns for their investors. Okay, so the research introduces this Q-factor model. What's the thinking behind that specific model?
Right, the Q-factor model. It's basically a way to put these ideas about investment and profitability into a more structured framework, specifically for understanding what drives stock returns. It looks at three main things: the size of the company, its level of investment relative to its assets, IA, and its profitability, usually measured by return on equity, ROE.
Okay, size, investment, ROE. We know smaller companies can behave differently, but how exactly do they measure investment and ROE in this model? Are they standard measures?
Pretty standard, yeah. Investment to assets, or IA, is typically calculated by looking at how much a company's total assets have changed over the past year relative to its starting assets.
Okay, simple enough.
And for ROE, they generally use the company's income before any unusual items, divided by its book value of equity from the previous period, often the previous quarter or year, depending on the exact study.
And why focus on these specific measures, investment to assets and ROE?
Well, we've already talked about how asset growth is a good overall proxy for investment activity.
Right.
And ROE is just a fundamental measure of how efficiently a company is using its shareholders' equity to generate profits.
Makes sense.
The model also usually includes company size because, as you said, smaller firms often show stronger effects related to both investment and earnings. So by looking at these three factors together, size, IA, and ROE, the model aims to provide a more complete picture of expected returns.
Okay, so we have a model considering size, how much a company is investing, and how profitable it is. What does the evidence actually tell us? How well does this model work in explaining actual stock returns?
The research shows some really interesting results, actually. For example, they find that the ROE factor, just on its own, shows a significant average return.
Okay.
And that's even after accounting for the traditional factors in models like FAMA French.
Oh, wow.
This suggests that ROE is capturing something important about returns that those earlier models might have missed.
And how does the Q-factor model stack up against those traditional models like FAMA French with value and size and Carhart, which adds momentum when it comes to explaining their factors, like the value premium or momentum itself?
Yeah, this is where it gets quite striking. The Q-factor model can largely account for the average returns of both the value factor, HML, and the momentum factor, UMD.
Really?
Yeah. In other words, it suggests that the returns we see from standard value and momentum strategies might actually be driven by these more fundamental factors of investment and profitability that the Q-factor model captures directly.
So HML and UMD might just be different ways of picking up on investment and ROE differences.
That's what the evidence seems to suggest. And interestingly, the traditional models like FAMA French and Carhart, they don't do nearly as well at explaining the returns of the Q factors themselves, the investment and ROE factors.
That sounds like a pretty big deal. It suggests investment and profitability might be more fundamental drivers of returns than just value or momentum as we usually think of them.
It's definitely a key takeaway from this line of research. The Q factor model also does a pretty good job explaining a wide range of other market anomalies. Things like the returns associated with earnings surprises, various other profitability measures. It often performs as well as or even better than the FAMA French and Carhart models in explaining these patterns.
Are there any areas where the Q-factor model doesn't do quite as well? Any exceptions?
Yes, definitely. The researchers are upfront about that. It seems to struggle a bit more with explaining the returns related to operating accruals and also R&D spending.
Okay.
For those specific anomalies, other factors or explanations might be more important.
And what about the size factor in the Q model? You said it's usually included. How crucial is it really?
That's a good question. The research also looks at a version of the Q factor model without the size factor
Uh-huh.
and finds that it still performs quite well across many of these anomalies. It suggests that while size can be a useful factor to consider, the investment, IA, and ROE components are really the main engines driving the model's success.
Interesting. So it's mainly about investment and profitability. The study also mentioned momentum, specifically price momentum and earnings momentum. What do they find there?
Right. The Q factor model tends to do a better job explaining the returns associated with both earnings surprises, like SUE, standardized unexpected earnings, and past stock price momentum,
Yeah.
like looking at returns over the previous 6 months, often called R66.
Better than the other models.
Often, yes. It frequently shows fewer unexplained returns, what researchers call significant alphas in these areas, compared to Fama French or Carhart. This further supports the idea that it captures some of the underlying drivers behind these momentum effects.
And just going back quickly to those operating accruals, you said it struggles a bit. Can you elaborate slightly?
Sure, while it doesn't fully capture the whole operating accruals anomaly where firms with high accruals tend to underperform, the Q-factor model does show some ability to account for return differences related to certain measures of accruals.
Okay.
It suggests there might be some overlap, maybe high accruals are sometimes related to high investment or low profitability, but it doesn't explain the whole puzzle.
Got it. And finally, the classic test. How does the Q factor model do when looking at the returns of portfolios sorted by both size and book to market? Those 25 Fama French portfolios.
Yeah, the benchmark test. The Q-factor model shows pretty comparable performance to Fama French and Carhart models when looking at these standard size and book-to-market sorted portfolios.
Okay, comparable.
But importantly, it often has fewer significant unexplained returns, fewer significant alphas, especially for the high book-to-market, the value stocks,
Well,
which again suggests it's capturing some of the underlying economic reasons behind the value premium, likely related to investment differences.
okay, so the Q factor model seems like a pretty powerful lens for understanding what drives stock returns. Now, the research also talks about Sharpe ratios. Why are those important when evaluating these factor models?
Right, Sharpe ratios, they basically tell us how much extra return we're getting for the amount of risk we're taking on, usually measured by volatility or standard deviation.
So return per unit of risk.
Exactly. A higher Sharpe ratio generally indicates a more efficient factor or a better model in terms of risk-adjusted performance. By comparing the Sharpe ratios of the individual Q factors and also the maximum Sharpe ratio achievable by combining the factors in each model,
Uh-huh.
we can get a sense of how well they explain risk-adjusted returns in the market.
And what do the Sharpe ratios tell us about the Q factor model specifically?
Well, the investment factor, IA, and the ROE factor in the Q model tend to have relatively high Sharpe ratios on their own, often higher than the traditional value HML and momentum UMD factors.
Interesting.
And furthermore, the Q factor model as a whole, combining size, IA, and ROE, seems to offer the potential for a higher maximum Sharpe ratio than the CAPM, Fama French, or even the Carhart model.
So potentially better risk-adjusted returns.
Potentially, yes. It suggests that investment and profitability are really important sources of common movement or co-movement in stock returns, and that the Q-factor model captures these sources pretty effectively from a risk-reward perspective.
So it's not just about chasing higher raw returns, it's about getting better returns relative to the risk involved. And the Q factor model seems to do a good job of that by focusing on these fundamental drivers.
Precisely. And it's worth remembering, the researchers often present this model as an empirical tool, a way to estimate expected returns based on observable firm characteristics.
Right.
It doesn't necessarily have to take a strong stance on whether the patterns we see are purely due to rational responses to risk or if there's some behavioral mispricing involved. The model simply highlights the strong predictive power of investment and profitability.
I see.
Though ideally you'd want a good factor model to also relate somehow to the concept of the efficient portfolio, the best possible combination of all assets.
Okay, so for you, the listener, what are the really key things to take away from this whole deep dive? This look at investment, profitability, and stock returns.
I think the main points are, first, that a company's investment decisions and its profitability are really important indicators, maybe more important than we sometimes realize for how its stock might perform in the future. Second, high investment can sometimes be a drag on those future returns, while strong profitability can be a positive sign, a tailwind.
Right, the counterintuitive investment part.
Exactly. And third, The Q factor model gives us a useful framework for thinking about these relationships. It suggests that these fundamental economic drivers, investment and ROE, might be the real story behind many of the patterns, like value and momentum, that we see in the market.
For me, a real aha moment was understanding how these seemingly simple measures, like book to market, or even just looking at a company's asset growth,
Yeah.
can tell us a lot about its underlying investment strategy and what that might mean for future returns. It definitely makes you look at those numbers in a whole new light.
Exactly. And hopefully, this has given you some new tools, maybe a fresh perspective for your own investment thinking. Maybe you'll start paying a bit closer attention to what companies are saying and doing about their investments and how that squares with their profitability.
So here's something to really chew on. If investment and profitability are such key drivers of returns, what are the implications for how you might build your long-term investment portfolio? Could focusing on these factors help you identify companies maybe poised for stronger returns, or perhaps spot those where expectations might just be too high right now? Definitely some food for thought there.
Absolutely.
Thanks for joining us for this deep dive.